My name is Jake, welcome to the channel. In today's video, let's talk about SCHD underperforming in 2025. Now I know, another video about SCHD. I just checked, I haven't made a video on SCHD in almost a year, so I feel it's okay if I make a video about SCHD once a year without, spamming my channel with just videos on SCHD. But in today's video, I just want to have a conversation with all of you. If you and I were sitting down in a room, we were talking about SCHD, this is generally what I would tell you in a video like this. So in this video, I'm going to do a quick recap of the index itself. A lot of people talk about SCHD, but don't even cover the index itself. So I'm going to give a brief overview of that. We're going to take a look at some charts. We're going to nerd out and all that kind of stuff. See how SCHD has been performing against different metrics. I'm going to share my thoughts and opinions on what's happening with SCHD right now here in 2025. What's happened to the golden child? Why is everybody, bashing SCHD? But yeah, I posted this meme here a couple of weeks ago on X, and I thought it was kind of funny, and I wanted to share it with all of you. I've been talking about SCHD and DGRO as a simple path to wealth with dividend investing, which was inspired by JL Collins. I talk a lot about that on my channel. I've been talking about this for about 4 years now, and SCHD is one of my largest holdings, representing a little over 50% of my portfolio. And I currently have about 35,000 shares of SCHD. So yeah, I like the ETF and I invest in it. And so I'm only sharing that with you because I'm biased, but I'm also a realist. And I just wanted to share with you that, yes, I'm heavily invested in this ETF and I believe in it that, for the long term, but it's important to understand what you're actually invested in. But with that being said, being an SCHD investor in 2025 has not been the funnest when comparing its results to the broader market. I mean, it feels like SCHD investors just can't seem to catch a break in 2025, and it could look a little like this. My gosh. Oh man, I love it. I love it. We are back. We're back. Okay, so let's take a look at the ETF SCHD, and there's a few things that I want to highlight. So first thing that you have to understand is what the index is tracking. So SCHD, like any other ETF, tracks an index. And the index that it tracks is the Dow Jones US Dividend 100 Index. I'm going to zoom in here so you can see it a little bit better. So yeah, it tracks this index right here. If you've never heard of this index and you just heard of SCHD, you're doing yourself kind of a disservice if you're not investigating and researching what the index is intended to do and what the rules of the index are before investing into an ETF. Okay. And so whenever I think about, hey, I invest into SCHD, no, I don't invest into SCHD. I invest into this right here, the Dow Jones US Dividend Index 100 Index, because SCHD is nothing more or nothing less than this index right here. So you might be thinking to yourself, well, what is this magical index? Okay, so if you go and you Google Dow Jones US Dividend Index, you will go to a site likely from S&P Global, and it talks about this index and the criteria and rules for this index fund. Because it's important to understand this is not a actively managed fund. This is a fund that has set guidelines and rules, and the fund is intended to just work that way. There's no manager, puppet master up there saying, okay, we're going to buy this stock and sell this stock. It's defined by preset rules. And the rules of this index are as follows. First, a company, in order for it to be considered for inclusion in this index, the company had to have paid a dividend for at least 10 years. Not a growing dividend, just a dividend in general. The market cap of the company has to be at least 500 million, and the traded volume, the annual daily volume traded or whatever, has to be $2 million. Okay, so that's not as important for me. It just means, the liquidity of the ETF. But now to the meat and potatoes of this index. So the way that the ETF is set up is there's certain criteria that the ETF is looking for in companies. The first thing that they're screening for is free cash flow divided by the total debt. So if a company has zero total debt, they're ranked at the very top. And then another criteria is the return of equity. And another criteria is the annual dividend, yield that the company is paying out. And then the 5-year dividend growth rate. So it doesn't screen for 10 years or 5 years of dividend growth that, just to be included, they've had to have paid a dividend for 10 years, but they factor in and screen based off of a 5-year dividend growth rate. Okay, those are the 4 things. And in addition to that, what they do is they rank those and they create a composite score based off of those 4 criteria, and eligible companies are ranked based on their composite score and included in the index. And every year they do what's called a reconstitution, where they do a reshuffle of companies in and out each year, because year over year, companies go up and down in value. These numbers, these metrics change for every company in the world, in the US, universe of stocks. And so every year, these companies are reevaluated for inclusion in the index based on these criteria right here. And another thing that's very important to remember is that no single company can represent more than 4% of the total index, and no single sector can represent more than 25% of the index. Now, this is incredibly important to understand. Now, when you look at, just the S&P 500, you'll see that some companies like Nvidia or Tesla or Amazon or Microsoft have maybe an 8 or a 7% weighting in the index. That is because those indices are based upon market capitalization. They don't have these criteria or rules in place to limit what percentage a company can be represented in the index. Now, this is fundamentally important when you look at the current climate of the economy today. When you look at the overall economy, you look at the Mag 7. You probably have heard of the Magnificent Seven, those 7 companies that are generating the majority of the earnings growth of the market. Those companies are so influential and so big that they're moving the entire market. So any ETF that doesn't overweight into those 7 companies are in most cases going to underperform an ETF or an index that is overweighting them. So SCHD does not include the Mag 7, and the Mag 7 is carrying the market. So there's no wonder that SCHD is greatly underperforming the market, simply because those companies, the Mag 7, which are carrying it, their shoulders are really heavy, they're carrying the market. Now, I want to touch on this very briefly. Now, I thought when looking back earlier in the year that the reconstitution in March was really the reason why SCHD is so, been underperforming so dramatically here in 2025. And I don't actually think that that's really the case necessarily. When I look at the reconstitution, what companies they kicked out, what companies they brought in, they didn't bring in any of the Mag 7, obviously. And so, the 493 other companies in the S&P 500, as an example, they've been insignificant in terms of moving the market, moving the index, the S&P, compared to the Mag 7. So I don't think, and this is just a gut feeling and what I'm seeing, the research that I've done, feel free to correct me in the comments, but I don't believe that the reconstitution in March really had it had a little bit, I'm sure, of the timing, because what happened in March and April was so dramatic. It was such like a roller coaster, and how quickly everything happened. The timing could have been, really, really off. But looking at the companies that they took out and they included, I don't think it really would have changed the story in terms of the underperformance that we're seeing in the, SCHD relative to the S&P 500 or the market. If they would have, if SCHD would have had its reconstitution in January, I don't think you would necessarily see as, I think it would have probably changed it by a few percentage points, but I think SCHD would have still dramatically underperformed the market. Okay. And that's just what I'm seeing here in the documents of the reconstitution, what companies they took out and what companies they brought in. Now, this is something that I want to highlight here really quick. The price to earnings ratio for SCHD is just over 16 times. So you're paying 16 times, the price for every dollar in earnings held in SCHD, in the businesses held in SCHD. So the PE ratio of this ETF is 16, but when you compare that to the S&P 500, the S&P 500 PE ratio is just around 30, almost double that of SCHD. Now, this is, you could interpret that as, well, the S&P 500 has the Mag 7, they're growing the earnings, at a much faster pace. Yes, that's true. However, when you look at the historical norm, a healthy PE for the market has been around a 20 times, right? And that's where, we kind of get out of hand at times where, you see when the PE kind of overextends, you have kind of this inevitable correction, right? And I'm not sitting here, I'm not Ray Dalio, I'm not Michael Burry, I'm not saying that the market's going to crash or anything tomorrow. I'm just saying that you have what's called the reversion, to the mean, a reversion of the mean. And, if the historical average of the index has been around 20, I don't know. But the counter argument to that is, well, the sector breakup of the S&P 500 has historically been higher in industrials and less in technology. And so the sector breakup is different. So therefore the historical mean is then irrelevant. So there's always a counter argument to everything out there. Here, while I'm talking about it, let me pull this up here really quick and touch on it. The S&P 500 technology sector weighting is over 35%. 35%, over a third, is in technology. And of that, about over a third is in the Mag 7. So any ETF that has been underweight the Mag 7, at least here in 2025, has underperformed the market because in reality, the market is those 7 stocks. It's 7 companies carrying the S&P 500. And at least that's the case today. If you follow, the news or CNBC, these analysts, they talk a lot about the rotation into value. I think that's something that happens on a regular basis. The market rotates from growth to value. It's just how the market works. But it's just so interesting. And what I'm trying to do with explaining this is all very rational of why SCHD has been underperforming so dramatically in 2025. It's simply because it's not designed to do what the S&P 500 has done so far in 2025. It's not designed to do that. So you can draw your own conclusion when looking at this. But what I see is the market at a historical high in terms of its PE ratio, whereas with SCHD, it's at a PE of 16. Now, you can make any argument you want. I'm not sitting up here saying that, it's black and white, because it's absolutely not. Like, there's a reason why the market is trading at 30 times and SCHD is trading at 16 times. All I'm saying is, in terms of historical averages, if I'm looking at the market right now today versus SCHD simply on a valuation basis, I'm a lot more comfortable owning SCHD at a 16 times forward PE ratio. But that's just my opinion. Now let's take a look at this and visualize what this actually means when I'm talking about the Mag 7 and the S&P 500, the total market versus SCHD. So when we take a look at VTI is the total US stock market, every publicly traded company in America, market cap weighted. And when we compare that to the overlap of SCHD, you'll notice that there's only a 6% overlap by weight. So the companies held in SCHD are only held at 6% in the total US stock market. And this is why I've been saying this for so many years, for so long. If you're a long-term subscriber of the channel, you've heard me say this so many times That's why I combine SCHD with another ETF like DGRO, because with DGRO, you get more market participation. We look at DGRO, you're getting about a 41% overlap weight with the total US stock market versus 6% with SCHD. So by combining SCHD and DGRO, you're getting more market participation. And because DGRO is an ETF that has different criteria and rules for screening companies, it includes other companies like Microsoft and Apple as an example. And that is why you're getting more overlap with the overall market. So to be a broken record and say this over and over again, that is why I combine DGRO and other growth ETFs in my retirement accounts with SCHD. And that's why I don't just own SCHD, because you don't get market participation with just SCHD. I now want to take a look at a few charts and share some of my opinions on a few things and kind of walk you through how I've been viewing this, investing into SCHD here in 2025. So, when I look at SCHD here, for those of you that know my story, I've been rebalancing my portfolio here this year. So I couldn't be happier that SCHD has been lagging, and I've had the opportunity to buy into SCHD at a higher forward dividend yield. Okay, so me personally, I'm very happy about this year that I've had the opportunity to rebalance my portfolio. If you are new to the channel, you don't know this, I've sold rental properties in the past. I've been reallocating my brokerage and investing strategy as a whole, and I've been allocating more of my, reallocating my individual holdings like Costco, Waste Management, Pepsi into just ETFs. So in my portfolio today, I own 4 ETFs, SCHD, DGRO, JEPQ, and JEPI. That's all I own today. I'm looking to actually tweak it a little bit, not much, but that's basically, that's all I own in my portfolio. But I'm really excited about that because this year I've been able to rebalance and get a 4%, right around a 4% starting yield or average yield with SCHD. When I first started buying SCHD back in around 2018, I was getting around a 2.5% forward dividend yield. And so seeing this here right around a 4%, I get excited about that. And so now that I'm basically done rebalancing, now I hope that it goes up. But for this last year, I've been really pleased that I've been able to get a higher forward dividend yield. And the dividend growth rate, this is what a lot of people talk about, is they look at the dividend growth rate of like 9 to 10%. Whether that continues or not, I'm completely fine holding SCHD at a forward dividend yield of around 4%. I have a theory, this is not just a theory, it's basically a reality. SCHD has been underperforming these last couple of years ever since the Fed started raising interest rates. Now you have to think about it, right? Why invest into SCHD, and take on equity risk when you can invest into a bond, a short-term treasury, and get no risk and get right around a 4% yield. Now, the challenge with that statement is you don't know when the Fed's going to cut rates, and it happens very abruptly. And so you could see the market flip within a day, within weeks. If the Fed were to cut interest rates over the next couple of years, you could see a massive shift or a rotation into high dividend stocks. There just hasn't been really the need for income investors and portfolio managers who manage real money, the real money of the world. If they have a target of 7.5% for their clients, they don't need to take on risk and buy SCHD. They can allocate money to bonds and then the rest into other, equities to generate their target returns. And so when you think about it from that perspective, it's all very logical of what's going on with SCHD in the current climate. Okay, let's take a look at a few charts here. So SCHD year to date, this is with the dividend reinvested. This is looking at the total performance. SCHD is flat on the year, but the S&P 500 is up 8.5%. So year to date, the S&P 500 is crushing SCHD. And I touched on this a little bit earlier with the reconstitution of its holdings. And I don't think that had that much to do, with the underperformance. I bet maybe, if I were to guess, probably 1, 2, or 3% of a difference. But SCHD is still underperforming the market 5+%. Just barring the reconstitution, leaving the reconstitution out of it. But what most investors do is they'll go and they'll look at a chart over the last 10 years and they'll see, hey, look, SCHD has done very well compared to the S&P 500 over the last 10 years. And that's the reality of it, right? You're going to have some bumps along the way. You're going to have years when the S&P 500 outperforms, underperforms relative to SCHD. You just never know what's going to happen in the economy. But I will say that, history does not repeat itself, but it does rhyme. And I found this to be incredibly interesting, and I wanted to share it with all of you. What you're seeing in front of you is a chart from the beginning of 2018 to about the middle of 2019. Does anybody remember what was going on? What was in the media? Like, what was the highlight of the year in terms of what everybody loved to talk about? It was the trade war with China. In 2018, the market was having a tantrum. The market was going crazy. And the S&P 500 outperformed SCHD for one of the first times since its inception. And so I caught notice of that. In 2018, part of 2019, with this whole trade war, tariffs, I was thinking of this, that maybe SCHD, that's SCHD's kryptonite, is trade wars and tariffs. And I was looking at that and thinking, okay, well, SCHD outperformed the S&P 500 in most of the other years since its inception, except for during the trade war of 2018. And then when we compare that with here in 2025, when the trade war talks started here towards the end of January, you notice that that's right about where SCHD started to underperform the S&P 500. And so my running theory with this is SCHD does not like trade wars, does not like tariffs. And so maybe that's SCHD's kryptonite, because other than trade wars and tariffs, SCHD has performed incredibly well during those other years. Now, the other caveat that I kind of want to throw in there, because I don't want to make broad assumptions, even though that's kind of a broad assumption, but in 2018, you also had interest rates were going up in 2018. So you had interest rates, but SCHD performed well during 2022 when interest rate relative to the market, right? So SCHD performed well in 2022 with interest rates going up, whereas in 2018, it didn't do well. But I think the correlation that I'm driving here is SCHD does not like trade wars and tariffs. And looking into the future, 10, 20 years from now, I would, kind of guess, looking forward, whenever there's a trade war, just assume that SCHD is going to underperform. So that's your hint, everybody. That's your crystal ball. When looking into the future, when the next trade war is announced, short SCHD and go long the market or the Mag 7. I don't know. Take what you will with that, but I just found that piece of information, the data there was pretty interesting. So what I hope you take away from this video is having a better understanding of what SCHD is and the index that it tracks, and that being the Dow Jones 100 US Index. Nearly all content that you're going to find on YouTube or elsewhere is backwards looking. SCHD did incredibly well during the early part of the pandemic. This led to an overwhelming amount of people praising it. Now that the market has shifted, and with it everyone's focus and praise, it's not surprising, at least to me, that people are looking away from SCHD because it has underperformed the market. This is largely due to the fact that the market is now weighted basically 1/3 into just 7 stocks, and that's the market, the Mag 7. Based on the research that I've done, I can see that the Mag 7 represent about 70% of the earnings growth of the entire US market this year alone. And so with that understanding, what this means is that almost all ETFs that have been underweight the Mag 7 have underperformed in 2025. SCHD is performing as it's designed to, regardless of what's going on in the market. The market is focused on earnings growth from the AI story. I don't know about you, but I don't see a lot of companies held in SCHD being at the forefront of the AI revolution. But that's okay. If you want stocks at the forefront of the AI revolution, then go buy an ETF that holds those type of companies, or hold those companies outright in addition to SCHD. That is why I've been saying this for years, to combine SCHD with another ETF that captures more of the market, simply because you just don't know what the market's going to do. You don't have a crystal ball. And that is why I've been saying combine SCHD with a dividend growth ETF like DGRO for times like these when SCHD underperforms or is out of favor, especially if you want to live off your dividend ETFs and live off the income and not just the growth and sell your shares. I would always get comments in my videos, years ago, why I wouldn't just hold SCHD. I can honestly tell you, I got that comment so many times. I had to reply, because you don't get market participation, et cetera, because people, only wanted to talk about SCHD back then, a couple years ago when SCHD was outperforming. And that's all people wanted. And they didn't think about anything else. They disregarded entirely that SCHD had around a 6 or a 7% market participation rate. So it's mind-blowing. And then again, it's not, because it's human behavior that we have recency bias. That's just what it is. But back in the day, I would get those kind of comments all the time. And they would always ask, do I really need another ETF? Well, fast forward to today, I guess, you did need another ETF, at least in 2025, because SCHD has been underperforming, because that's not what's in favor or, the flavor of the day here in 2025. So the bottom line is, people who are flat out angry about SCHD underperforming, because there's plenty of them out there, love to hate on SCHD right now. They don't truly understand what they're investing in, or they bought SCHD with the wrong expectations. There's one thing that I know for certain, and that is no one can time the market. The market is known for making the best investors look foolish. It wouldn't shock me one bit if next year the market was down 50% and SCHD was up 30%, or if the Mag 7 just kept going up another 100% next year and SCHD was down 30%. I can't be surprised anymore. I've seen too much. The stock market works in cycles. Try and keep your emotions at bay and enjoy the journey. Thanks for watching.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.